Guys, with inflation eating away at our dollars, I believe it's a good idea to have some real assets like a house or maybe a rental property. But not everybody wants to deal with the proverbial fixing a toilet late at night in a renter's apartment. So, can you really get the same exposure and rate of return that you get with a house or a rental by buying a real estate investment trust that you can just buy or sell with the click of a mouse? I'm going to take a look at the different sectors of REITs and have a look at their performance and talk about any problems they might be facing. Also, I'll look at some of the biggest REIT ETFs and compare them and see what they are made of and what percentage of the REITs are in the so-called problem sectors. Now, most people won't believe me, but actual returns on housing is about 3% a year historically, going back like 100 years. And real quick, looking at this data from NYU, the returns on different things from 1928 to 2023, S&P 500, bonds, real estate, and gold. And so these are the annual returns for all of these different assets. Scrolling at the bottom, we see the S&P 500 is 22.25% per year over these almost 100 years. Bonds are somewhere from 0.74 to 1.89 to 5.45, depending on the type. Gold is 9.84%, and real estate here, 3.08%. So most people are thinking, well, my real estate has gone up a lot more than that, especially in the last few years. Well, that is the average over all the years on different periods with different types of inflation. But historically, that's basically what it does. And houses don't appreciate. Houses depreciate. It's the land under it that appreciates, and that doesn't even really appreciate. It's the dollar that the land is priced in that is depreciating. But still, real estate is a good investment because it's a real asset and you can actually live in it, even if your gold gets stolen or the dollar goes down to almost nothing or your stocks go down, you still have a place to live in. And because of leverage, meaning most people buy their house either 5% down, which is actually 20 times leverage, or say 20% down for a rental or something like that, it's still 5-to-1 leverage. So even if it's going up 3%, you're actually making 15% on your money if you have 5-to-1 leverage of the money you put down. So the problem with REITs is you don't get that leverage when you buy a REIT. Technically, you can get 2-to-1 leverage if you buy it on margin, but that defeats the purpose because you're going to pay margin interest, which will probably be more than the return of the REIT. Now, everybody knows that office buildings are problematic because less people are coming back to the office after the pandemic. But everybody sees that residential real estate and rents have gone sky high for apartments. So should you just buy the REITs and skip the problems of the office REITs? Well, not necessarily, because those other REITs can have the same problems that the office buildings are having, because most of those REITs are buying their buildings with interest-only loans with balloon payments at the end of the loan term, which is usually only like 5 or 6 years. So this article from the Wall Street Journal about a year ago talks about it, that interest-only loans helped commercial property boom. Now they're coming due, and $1.5 trillion worth of commercial mortgages are due over the next 2 or 3 years. So they say, unlike most home loans, commercial mortgages are known as interest-only loans. Borrowers make only interest payments during the life of the loan, with the entire principal due at the end. And so the share of interest-only loans have increased up to 88% in 2021, up from only 51% in 2013. So when interest rates were low, the owners would just pay off the debt by getting a new loan or selling the building. But borrowing costs are getting more expensive, and lenders are becoming more reluctant to refinance these loans, especially in office buildings that may have a lot lower vacancy now. So many of them are stuck when their loan comes due. And so here's a chart of CMBS loans that are interest only by year of issuance. You see in 2010, it was under 20%, and now after 2020, it is above 80%. So I'm going to look at the performance of different REIT sectors, and I'm going to start with the one that draws the most attention from most investors when they start sorting on REITs by highest dividend to lowest, and that is mortgage REITs. Now, mortgage REITs don't actually own any real estate. They're kind of like an investment fund that buys mortgage-backed securities, and they use leverage to get bigger returns on these mortgage-backed securities. So when you see these returns of 13% dividend or 10% dividend, that is very risky. And those mortgages are good when interest rates are going down because the price of the bond becomes more valuable. But when interest rates rise, the longer term bonds that they have go down in value a lot, as you have seen in the bond market. So let's start there. So if you go to finviz.com, they have a scanner and you can look at the different sectors. And I selected mortgage REITs, and you see there are 38 of them, and they have dividends anywhere from 17% down all the way to 1.46%. When I use the term dividend replying to REITs, just know that it is not an actual dividend like you get from Coca-Cola. Those dividends are qualified dividends if you hold them more than 6 months, and they have a max tax rate of 20%, whereas these dividends are not dividends, they're distributions, and they are taxed like interest on a CD or a T-bill or something like that. So they're taxed at your highest tax bracket. So if you are thinking of buying REITs, you should definitely try to put them in a tax advantaged account like a 401k, an IRA, or Roth IRA. So let's look at the 5-year chart of these mortgage REITs. And you see most of them are not doing very good. The first drop was for COVID, and then the second drop was for interest rates increasing, right? Another page, they all have the same kind of look to them, and they are generally all trending down. And so just because they pay a big dividend now, they may not pay that in the future. They may have to cut their dividends. So it is anything but guaranteed. Okay, let's look at diversified REITs. There's 17 of them, dividend of 15.5 all the way down to 0.5. And what diversified means is they may own some office buildings, they may own some industrial warehouses, they may own some apartments or some mix of that. But you see, generally, they all have kind of the same shape. And especially around 2022, when interest rates went up, they all started going down. Okay, looking at healthcare facility REITs, 17 of them, anywhere from 12.6 to 1.75. Again, the same kind of downward trend, especially since 2022. And some of them that are senior care did really bad during the pandemic. So it looks like CTRE and Welltower are the only ones that are mildly above where they were 5 years ago. Hotel and motel, there's 16 of them, anywhere from 13.9 to 0.28%. Most of them took a big dip during COVID. Some have recovered a little bit, like HST, but most of them are well off of their highs from 5 years ago. Industrial REITs, there's 16 of them, yielding anywhere from 7% to like 1%. And these are one of the better categories. It looks like some of them, like self-storage, have held up or actually gone higher, like public storage. Prologis is probably one of the better ones and is usually the top holding in these REIT ETFs. They are a logistics REIT, so think ports and shipping terminals and truck terminals and that kind of thing. And so they are up from $60 to as high of around 170 or so. Now it's around 107. All right, this one has not done that bad either. First Industrial, EGP, TRNO. So far, this is the best performing category, it looks like. Now, office REITs. There's 24 of them with a dividend of about 12.5 to 2% or less. And just looking at these charts, you see they are almost all in a pretty significant downtrend. Right? Maybe this one, COPT Defense Properties, is at least holding its own. Vornado is a popular one, and yet it's down from like $60 to 24. So offices have the double whammy of the higher interest rates like everybody else, but they also have the problem of people not wanting to go back into the office to go to work after the pandemic. And here's the Castle Back to Work Barometer for the New York Metro. This company runs those swipes on the turnstiles on these buildings where people swipe in to go into their office building, so they know exactly how many people are coming back to work. And you see in 2020, it was less than like 10%. But even now in March 2024, it's still under 50%. So if these companies can't get people to come back to work, then they don't need all that space. And so they may be getting rid of their leases or reducing their real estate footprint in these offices, especially in some big cities. And so because of this, you see office loan delinquencies are increasing. Looking at office, retail, hotel, multifamily, industrial, and others, you see the black line. Office is now above 5%, where some things like industrial and multifamily are a lot lower. Hotel and retail were a lot higher during the pandemic, but now they have come down, and so they are now having less loan delinquencies percentage-wise than the office REITs. So now let's look at residential REITs. This should be the best one, right? Because everybody knows rents have gone sky high, home prices have gone up a whole bunch, so these should reflect that as well, right? Let's take a look. Dividends anywhere from 9% to like 1% or less. There's 21 of them. Let's look at the charts. And you see they are generally a lot better than some other sectors. BRT went from about 12 to 25 and now is about 18. UMH, NXRT. Now you notice one thing though, that although they are doing relatively better, they all had these peaks around 2022, right before interest rates rose up, and they have fallen in some cases 50% or so from their highs, right? More of them here from 350 to 200, from 200 to 117. This one is actually doing good. Invitation Homes, American Homes for Rent is actually positive. So this is a very strong one, it looks like. Same kind of with ELS as well a little bit. But if you compare these charts to a chart of the average home price for the last 5 years, they look nothing like it, right? So buying these is not the same exact thing as buying a single family house or a duplex or some multi-family building yourself. Next is retail REITs. There's 28 of them, anywhere from 7.15 dividend to 4% or lower. And these don't look terrible. They don't look all great, but not as bad as some other sectors. Realty Income is very popular with a lot of people. It's basically gone nowhere or a little bit down over the 5 years. Simon Property Group, which owns a lot of malls, fell as low as like $50 during the pandemic. Now it's back up to $148, right? So it's kind of a mixed bag. Some are holding up a little bit. Some are still down a good amount. Some like SKT, Tanger is the outlet stores, and they fell to as low as $5. Now they're up at 27. So depending on when you bought it, you may be up a little bit or up a lot, right? But something like this one is basically down 90% or more. And last, let's look at specialty REITs. And these can be all kinds of things, from advertising billboards to data centers to cell phone towers to even timberlands where they sell wood. So they could be kind of a good uncorrelated asset, so to speak. And so some are better than others. GLPI, Gaming and Leisure, has done well. Lamar Advertising has done okay, right? Digital Realty Trust was doing pretty good, but after the interest rates started coming up, they have done less good. I would say this is probably as good or second best to the industrials sector, right? Iron Mountain has done very well. It's a standout here, as well as Equinix, which is also data centers, I believe. AMT is American Tower, the cell phone towers. And so while it is kind of a monopoly, cell phone companies aren't going to switch towers. they have done bad since interest rates have been going up. So overall, those REIT sectors are not doing that great. You can look at it two ways. One, you could look at it as a buying opportunity, especially if you think interest rates are going to start to go lower, that some of these REITs can refinance at lower rates when their mortgage comes due. Or if you think interest rates are going higher, you might think that there's more pain ahead for a lot of these REITs. So if you're still interested, you could pick out a few of these REITs that you think will do better than others, or you can just buy a REIT ETF and have a whole bunch of diversified REITs, 100 or more different REITs in there, so that some will do good, some might not do so well, but you get the overall return of the REIT. So I'm going to look at the 4 biggest REITs and compare them and see if there is that much difference in what they hold, their performance, and their expenses. So looking at the 4 biggest US REITs, that's Vanguard, Schwab, Spider, and iShares. And so their holdings are anywhere from only 33 with the Spider to 159 with the Vanguard. But the top 10 REITs that they own are all better than 40% of the total fund. This one is almost 60%. So they are very concentrated. And so I'm going to see if they have most of the same REITs in the top 10. As for expenses, Schwab is the cheapest at 0.07. IYR, iShares, is the most expensive at 0.40. So almost 6 times as much as Schwab and almost 3 times, a little more than 3 times more than Vanguard. Now, their annual dividend yields are anywhere from 2.83 up to 4.24. Again, this is not a dividend, this is a distribution, and a portion of this, up to maybe 30% in some cases, like Vanguard, I believe, that dividend is not actually a dividend. It could be a distribution of a capital gains or a return of capital. So generally, you're looking at probably about an actual 3% or so dividend on all of these. So looking at Vanguard's VNQ, you see the number one holding, 13%, is actually one of their real estate funds. But after that, it is Prologis, American Tower, Equinix, Simon, Welltower, Public Storage, DLR. Notice these names because they're going to come up in the next 3 ETFs as well. All right, Schwab, Prologis, number 1, American Tower, number 2, Welltower, Simon, Equinix, Public Storage, DLR. All right, XLRE, same thing, Prologis, American Tower, Equinix, Welltower, SPG, PSA, DLR. iShares, IYR, Prologis, American Tower, Welltower, Equinix, Simon Property Group, Public Storage, Digital Realty Trust. So you see these funds hold mostly the same thing. So let's see what their performance looks like on a chart going back as long as we can. The Vanguard VNQ started around $75 around 2014 and is now around $82. Had a high in 2021 of 116. So it's down around 30% from its high. The Schwab goes back to around 2014 at around $18. Right now it's around $19.50 and had a high of $26.54. That's also close to a 30% drop from its high. XLRE goes back to 2015 at around $30. Now it's $37, had a high of $52. That's about a 25% drop or so from its high till now. And IYR goes back to 2014, around $70. It's around $86 now and was as high as about $117. So that's a drop greater than 25%, maybe 27 or so. So looking at the returns for Vanguard year to date, they're down 9%. Over 10 years, they're up 4.98% per year. And since inception 2014, about 7%. And although it's not sorted by highest to lowest, at least they tell you the percentage in the different sectors, so you don't have to figure it out on your own. So for instance, if you don't want to have a lot of office REITs, this one only has 4.7% and has almost 12% in telecom tower REITs and even 2.5% in timber REITs. And data centers, almost 9%. The Schwab ETF is down about 9% year to date, 3.63% over 10 years, and 5.79% per year since inception. Unfortunately, they don't break down the sectors that they have. So they'll tell you Prologis 8.1, American Tower, but you don't know, is it an office REIT? Is it a retail REIT? You have to go and look all that stuff up yourself. Not very investor friendly. The Spider XLRE is also down 9% year to date. They haven't been around 10 years. Their 5-year return is 3.57, and since 2015, about 9 years, 5.79% per year return. And so they show the percentage of the fund compared to the index and by sector, which is very handy, because you can say, okay, I like a lot of specialized REITs. This one has 43.68 and only 2.89 office REITs. The iShares IYR is only down about 4% year to date. They don't have a 10-year performance. They've been around almost 10 years, and so their return was 3.48% over those years since about 2014 in July. So in just a few months, they'll have a 10-year track record. This is significantly lagging, say, the Vanguard or the Schwab or even the XLRE. And why are they lagging? Maybe because their number one concentration is 19% in retail REITs, which have been taking a hit. Office REITs are a lot higher than the other ETFs, 7.76. So that could be part of the reason for the underperformance in the last few years. So after looking at all of this data, I'm really not that impressed with REITs. You might be better off just buying dividend stocks or even a dividend ETF. You see that interest rates are a really big factor in all of these REITs pretty much. Not one of them has been spared very much. So you can buy a REIT ETF hoping for a turnaround and maybe lower interest rates and things getting better. And if that happens, you can get a really nice gain in a few years on these REITs maybe. Or you can say, well, I'm not really into these REITs because of these problems, but there are a few REITs that are interesting because they're kind of like an uncorrelated asset, like maybe these data centers or cell phone towers, or the logistics REITs like Prologis, or even maybe like some timber REITs or advertising sign REITs, something along those lines. So let me know what you think after watching this video. Are you more inclined to buy some of these individual REITs or one of these REIT ETFs, or just no REITs at all? And probably if I was going to buy one of these REIT ETFs, I would probably just stick with Schwab or Vanguard. They have very low expense ratios and you kind of know what you get with them. I hope you like this one, guys. I'll see you in the next one. Thanks for watching.